Thanks for clicking. The Bank of Canada would rather raise interest rates too much than not enough. This was the message coming from the Bank of Canada Governor Tiff Macklem at his final speech of 2022. The message stands in stark contrast than that which was taken by some, following the Bank of Canada's decision to only raise interest rates by 50 basis points at its December 7th announcement, only 50 basis points, with many onlookers at the time viewing the 50 basis point rate hike as an indication that the bank might be ready to pause its path of interest rate hikes. But a pause on rate hikes certainly wasn't the message coming from the Bank of Canada governor at his speech on Monday. Bond yields shot up on the speech, more so than they declined following the rate announcement, as the markets took the speech to indicate that the Bank of Canada might indeed continue to raise rates into 2023.
Did you hear what I said?
So what I want to do today is go over the speech, looking at how Governor Macklem says Canada arrived at a 7% inflation rate, look at where he sees Canada is heading in 2023, and then discuss some implications for the future. 2022 is definitely winding down, but we still have an update coming out from the Canadian Real Estate Association with November's real estate data, and we'll be getting Canada's inflation rate next week, and we'll obviously have updates out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the speech. Governor Macklem began his speech by admitting that Canada's inflation rate is far, far off from where it's supposed to be.
At about 7% today, inflation is a long way from what we had expected. What happened?
That's all, folks.
Seriously though, Governor Macklem outlines 3 surprises that the Bank of Canada did not foresee at this point in time last year, which led to the 7% inflation rate that we saw in 2022. First off, supply chains.
First, supply problems, both global and domestic, proved to be more persistent and pervasive than we had anticipated. This put upward pressure on many prices.
So, supply chain problems, periodic shutdowns, led to a lack of supply. Combine that with an increase in pandemic spending, you have too much money chasing far too goods, equals inflation. Second, Russia's invasion of Ukraine.
Second, Russia invaded Ukraine, sending prices for energy and agricultural products sharply higher.
And this explanation was heavily expected, as the Bank of Canada has blamed Russia for sending our prices up throughout 2022, which it probably did, but later on in 2022. But I do think it's important to remember that in January we found out that December CPI was sitting at 4.8%, with grocery prices rising at the fastest pace in a decade. In February we found out that January CPI was at 5.1%, and Russia still had not invaded. Russia ordered its troops into the Ukraine on February 22nd of 2022, and the Bank of Canada raised interest rates for the first time a few weeks after that. So yes, higher energy prices caused by the Russian invasion of Ukraine, definitely later on, but it's important to remember that even before the invasion, we were still at a 5.1% inflation rate, far, far off from where the bank was supposed to be.
Memory on you.
And third, the governor said with the economy finally reopening, combined with pent-up pandemic savings, led to a further increase in prices.
And third, once we got through Omicron early in the new year, the economy fully reopened, and consumers wanted to catch up quickly on what they had missed for 2 years. But businesses could not keep up with demand, and this put significant upward pressure on services prices.
So, in summary, the governor says that the breakdown of the supply chains, the Russian invasion of Ukraine, and pent-up pandemic savings led us to the 7% inflation that we're seeing right now.
With the information we had a year ago, it was impossible to foresee all these developments.
But I'm not sure that impossible was exactly the right word. The supply chains breaking down? Probably, yes, definitely. Russia's invasion of Ukraine? Impossible to see? I don't think so, but the bank couldn't have done anything about that anyway, so fair enough. But the glut of pandemic savings flooding into the economy upon reopening being unpredictable? The Bank of Canada knew as early as March of 2021 that Canadians had amassed $180 billion of pent-up savings. Laurent Chambry, then Deputy Governor of the Bank of Canada, noted in a speech in March of 2021, Canadians continuing to buy houses and goods at a similar pace, but dipping into their savings for services, would be a positive surprise. So, supply chain pressures? Yes, definitely unpredictable. The Russia invasion of Ukraine? Probably predictable, but the Bank of Canada couldn't have done anything about it anyway. The glut of pandemic savings entering into the economy? Probably entirely predictable. Regardless though, where are we going into 2023? As we know, the Bank of Canada has been raising interest rates in order to tamp down demand, make the cost of borrowing higher, tamp down that demand, and give supply a chance to catch up.
By raising interest rates, we're trying to dampen demand so supply can catch up. That will bring the overheated economy back into balance, and inflation will come down.
But whether or not the Bank of Canada has done enough, or do they need to keep raising rates, is the real question. And the Bank of Canada Governor made it clear that the bank is willing to continue to go higher on interest rates into 2023.
If we raise rates too much, we could drive the economy into an unnecessarily painful recession and undershoot the inflation target. If we don't raise them enough, inflation will remain elevated, and households and businesses will come to expect persistently high inflation. With inflation running well above target, this is the greater risk.
And yeah, we've talked about that before on this channel. If the Bank of Canada raises rates too high, if rates go so high that they cause a severe recession, the Bank of Canada has a tool for that: quantitative easing. The money printer, stagflation concerns aside. It knows how to print or create its way out of a crisis.
We're getting really good at it.
On the other hand, if it doesn't raise interest rates high enough and inflation is allowed to take hold, or take hold even more, then it risks having to raise rates even higher in the future.
If high inflation sticks, much higher interest rates will be required to restore price stability, and the economy will have to slow even more to restore price stability.
So, in summary, at this point in time last year, the bank did not anticipate that we would have supply issues, that Russia would invade Ukraine, or that there would be a flood of pandemic savings heading into the economy upon reopening. But here we are. The bank sees more risk in keeping rates too low than it does in keeping rates too high. And as we saw, if the bank does cause a major recession, does cause a severe recession, then they can always lower rates back down. The trouble comes if inflation takes hold, then rates could have to go higher for longer. And I think the governor's speech at least acknowledged this year some of the uncertainties that we see going into 2023. The bank doesn't really know how long inflation is going to take to come down, how long or how many interest rate hikes it will take to get that inflation rate back down to 2%. And even if it did know, all else is not equal. We don't know what's coming down the pike from China. We don't know how the Russian invasion of Ukraine is going to play out, all of which will have an effect on our prices. So, going into 2023, with the potential for inflation remaining sticky, it's not clear that the Bank of Canada is done raising interest rates just yet. With that said, we'll have a much better idea of where the Bank of Canada is going to be in January when we get that inflation data out next week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.